It's after the great financial crisis, and here we are today with Rosa Roubini and Brunello Rosa, today partner in Rosa Roubini Associates, discussing the great financial crisis, the outcome of this crisis, and obviously how it all started. Welcome, Rosa Roubini. Thank you for being here. Just try to understand. I mean, you were called Mr. Doom for predicting this crisis, but actually you were absolutely right. How do you feel today?
Well, I usually say that I'm not Dr. Doom, I'm Dr. Realist. The important thing is not to be optimist or pessimist, but trying to independently understand how the world works and try to figure out whether things are going in the right direction or the wrong direction. So I got this nickname, but I'm usually a kind of a objective observer of what's happening, so you have to be really cautious and realistic.
Nadia, can we remember again how it all started? I mean, how, first of all, you managed to predict the crisis and how it all started and how it all developed?
Well, I would make the following observation, and I wrote a whole book after the global financial crisis titled Crisis Economics. And the broad observation is that while, of course, there are many differences between different financial crises, there are also some similarities. And I've done a long work also on financial crisis in emerging markets, and I had written a book about it a few years before. And the point is that while there are differences, financial crises have similar commonalities. You can have, first of all, an asset bubble. That asset bubble could be in internet stocks, could be in housing, could be in a new technology. You have the beginning of build-up of leverage as people borrow against rising asset prices. This leverage can be in the private sector, but also situation of risk where excessive deficits of the government lead to a build-up of public debt. There is a situation of complacency where things are going well and everybody becomes bubbly. Private sector becomes corporate, financial institution, households, regulator sleep at the wheel, and there is a feedback between the build-up of the credit bubble and the asset bubble. There is excessive leverage, excessive risk-taking, and at some point something cracks. Economists refer to it as the Minsky moment because Minsky was one of the few non-mainstream economists who saw the nature of financial crisis and wrote about them. And then you have unraveling from an asset and credit boom and bubble, then you go into an asset and credit bubble going into a bust and a crash. And what went up starts to go down, and there are lots of economic and financial consequences that lead to a crisis and a recession as well. So this is the broad framework. In the specific of the global financial crisis, of course, the beginning of it was a housing bubble in the United States, mostly for people who could not afford homes. That's why it was a subprime, with subprime mortgages being the center of a build-up of excessive leverage, but home prices were increasing and became a broader credit bubble that was not just in housing and in credit, but also in other parts of the economy. And of course, some of the international dimension of it are driven by forms of contagion through trade and financial link, but the reality was that there was also a housing bubble in other parts of the world. There was a housing bubble in Ireland, there was a housing bubble in Spain, there was a housing bubble in Iceland, there was a housing bubble in Dubai, and no wonder it was actually a housing bubble also in the United Kingdom. And no wonder that then when the bust occurred, while people concentrate on the US housing boom and bust, there was also a bust in all these other countries. So some of the contagion globally was not contagion, but that you had similar type of phenomenon of asset and credit bubble in many other parts of the world. And that's part of the element that became international. Of course, then there are specific elements to this one because we were in a period of time where maybe the Fed started to tighten too little too late, and that allowed asset bubbles to be fed. It was a period of time where there was a glut of global savings because of what China was doing in terms of its current account. And while the Fed was raising short-term interest rates, long-term interest rates were remaining not as high as before. This was the bond conundrum, why long rates are not going higher. So financial conditions were easy. Regulators were asleep at the wheel. The Fed was not doing its job, both in terms of monetary policy and also dealing with asset bubble. And the other phenomenon of it that was specific was there was this process of securitization. You started with mortgages, you slice them and dice them into mortgage-backed securities and CDOs and CDOs of CDOs of CDOs. And in this securitization chain, everybody was making some money and charging fees. The banks, the mortgage originator, those who were appraising the loans, the rating agencies, the bond insurers, the investment bankers, and you were essentially transferring the credit risk down the line from mortgages to very complex instruments that were complex, were not seen before, mispriced, where nobody knew what the fundamental risk was it, and everybody in this securitization chain was making actually a cut and transfer the risk. And eventually had these instruments that look like monster with CDOs where the AAA tranches looked like AAA, but they were not AAA because the underlying assets were actually subprime mortgages, were very risky. And therefore, that created also a sense of confusion, lack of transparency. And then when the panic occurred, of course, you don't know what's bad, what's good, who's solvent, who's insolvent. And that type of element of a panic is also an element that leads to more market reaction, the fire sale, and then the snowball down of the bust and the crash. So lots of different things are happening.
So can we also talk about what the effects of this great financial crisis were on the global economy, on GDP growth, on employment, on inflation, on everything?
Well, first of all, what happened was that once the bust and the crash of asset prices occurred, you got this negative feedback between the financial system and the real economy. So what started as a stress in the financial system and housing led to a banking crisis and led to a recession. And then there was a negative feedback between those two elements at the US level. And then the question is why the recession in the US became a global financial crisis. And I would say there are many factors at work. One was that similar kind of bubbles were occurring in Spain, in Ireland, in Iceland, in Dubai, you name it. And therefore, once the bust occurred in the US, it occurred in other parts of the world. Secondly, of course, people say the US is the largest economy in the world. When the US sneezes, the rest of the world catches the cold. And the US was not sneezing, was having a severe bout of pneumonia. And therefore, the contagion became more severe. There are trade links are important. When the US goes in recession, it has a shock. There's a confidence effect when the largest economy in the world goes bust and the stock market goes down, then there is panic and asset prices in other countries go. But there were also very important financial links of the following sort. When this process of securitization occurred and these mortgages were repackaged as mortgage-backed securities and as CDOs and you name it, these things were not just sold to US investors, but a good chunk of it were sold to foreign financial institutions, including many of the Europeans. So when the losses occurred in the US for US investors and US banks, then also similar kind of losses occurred for European and other financial institutions. And when those went bust, then the panic started, the uncertainty, and the transmission of the financial shock occurred through also this direct investment channel. And of course, the policy reaction at the beginning were too little too late. People did not even believe that the shock was going to lead to a recession. The Fed within his view had the wrong view that actually this will be just a problem of housing, a problem limited to a couple of $100 billion of losses, and the 200 became half a trillion, the half a trillion became 1 trillion, the 1 trillion became 2 trillion, and then of course people reacted too late, eventually aggressively, and then the economic shock and the financial shock became more severe, and it spread also internationally.
Do you think the tools that were used over the financial crisis, during the financial crisis, were really effective, though, looking back now?
They were effective in the sense that this Great Recession could have ended up into, Great Depression 2.0, and between, Lehman and the beginning of 2009, actually, the collapse of world GDP, consumption, investment, exports, and economic activity was similar, and the pace of it, to the beginning of the Great Depression, so we could have ended up into the Great Depression. But finally, after misinterpreting the crisis and all the rest, Ben Bernanke and his other fellow policymakers in the world had studied, in particular Bernanke, the Great Depression, and they realized during the Great Depression there was monetary tightening, not easing, there was no use of fiscal policy. The attitude was let firms and banks default, liquidate, and that implied that the financial shock, stock market crash of 29 became the Great Depression. So they learned you need massive monetary easing, you need massive fiscal easing, you even need backstop, not just the financial system, but the private sector, the corporates and the households, and make sure that this financial shock doesn't imply another severe depression. And if you look at the results, people have complained about quantitative easing and distortion and the moral hazard and the rising inequality. There have been a long series of arguments against quantitative easing and commercial monetary policy, but the country that used it eventually got out of that recession, and the country that used it more aggressively, like the US, got out of this severe recession sooner and faster than Europe. And it was not just the quantitative easing, but if you compare, say, US and Europe, Europe had the recession and the recovery was deeper recession and recovery was more shallow. What are the three differences between US and Europe? US started unconventional monetary policy sooner and more aggressively than Europe. The US decided initially to have a massive fiscal stimulus while you had fiscal austerity in Europe. And the US decided that in spite of moral hazard and too big to fail, the financial system should be backstop and provided capital and other liquidity. And then, yes, there was a credit contraction, but it was more limited. And then gradually the US financial institution started to recover faster and sooner, while in Europe you postponed that stress test, so you fudged them 2 or 3 times until eventually you figured out we have to fix the banks, and if we don't fix them, but then it was done much later than before. And the combination of the fiscal, monetary, credit, and financial approach to resolving the system implied that the US worked faster, sooner, and better than Europe, and that explains the differential in growth rates, in the recovery, and the severity of the crisis.
So there have been many changes also when it comes to well, social life. Let's talk about political developments, the rise of populism, Trump, Brexit. How many of these do you think were an effect, indirect or direct effect, of the great financial crisis?
Well, some of that malaise of working classes or middle classes that led to the rise of economic and political populism maybe predated the global financial crisis because, you know, combination of globalization, of trade, of migration, and so on implied there were winners and losers. And the losers and those who were left behind were those who didn't have the skills and the tools to survive and thrive and succeed in a digitized and global economy. And therefore there was already a certain degree of malaise. But, you know, at least before the global financial crisis, those who were left behind could keep up with the Joneses in the Anglo-Saxon country by borrowing against their housing wealth and therefore spend more than their income, even if it was not sustainable. And in countries in Europe where that did not occur, the government was providing more public services for free and not fully taxing for them, and therefore you're increasing of fiscal deficit to make up for this lack of economic growth and opportunity for everybody. After the global financial crisis, that part is over. Those who are left behind, they cannot borrow to try to keep up with times and spend more than income. And those who have a larger budget deficit, and that also had to squeeze, and therefore that implies a squeeze. So, and then there was a severe financial crisis, there was a severe recession, the recovery was anemic, unemployment rate remained high in many countries, inequality was already large, has been rising even further. Of course, inequality depends on longer-term trends of trade, globalization, migration, technology, but the financial crisis became more severe. And there was also the perception that we bail out those who screwed up. The traders, the bankers, and so on, they were bailed out while the average guy did not get enough debt relief. So that created also more fuel. And also that the policy response, quantitative easing, might have fueled an asset bubble that benefited those who had assets, but not those who did not have. And therefore, this combination of, malaise was in part, what triggered then the rise of populism of the right and populism of the left. So some of these long-term factors, how much trade, globalization, migration, technology, benefits some and hurts others, but then, of course, the global financial crisis and economic and financial shock exacerbated it and led to these kind of anti-establishment political parties and systems and so on.
Brunello, do you think that liberal democracies are now equipped to counter the rise of populist parties?
Liberal democracies have plenty of instruments to deal with the phenomena we are seeing at the moment. The question is whether they are willing to use them or not. Income redistribution would be one of them, from the richer to the poorer. That would help part of the problem, not everything, because that's a very complex situation that has led to the rise of populist parties, including migrations, the sense of loss on sovereignty, and so on and so forth. But the fact that the loss of people felt kind of worse off because of globalization, because of trade, because of technological advancement, and so on and so forth, had led to the rise of these populist parties. Once you solved the economic problem, you have solved at least a great part of the issue. Now, of course, other things then need to be implemented in terms of a better distribution of sovereignty between local level, state level, supranational level. This takes a lot of time to be arranged in an efficient manner, but you need to start somewhere. At the level of European Union, at Eurozone, the debate is whether it will ever become a transfer union, where some of the implicit transfers from the periphery to the core are eventually reversed into explicit transfers from the core to the periphery. This is a debate that's been going on for a very long time. We never reached a point in which there's a breakthrough. The question is whether the rise of these populist parties is effectively a wake-up call for people in the core, and understand that unless they solve this problem, the situation is not going to get better.
What's your take, Maria?
I agree with the points that Brunello made. I would maybe add the following points. First of all, I'm not sure that protectionism is the right solution to the problems that globalization leads and displacement and people left behind. The first optimal policy will be to provide everybody with the kind of skills, education, retraining that allows you to be successful in a globalized world. Secondly, protectionism may help some jobs, but increases the price level for everybody. So some workers are better off, but the average consumer is worse off. US experience sometimes suggests that every job that has been saved has had a cost for society of up to $1 million. That is a multiple of the average wage of that worker. And the other point that is important is that if you could unilaterally impose trade restriction, you might make at least some workers better off. But the risk of starting trade wars is retaliation. And if there is retaliation, I can impose restriction on your exports, but some other country is going to impose restriction on my exports. And once you ended up in a generalized trade war, like it happened during the Great Depression, starting with the Smoot-Hawley tariff, that can worsen global economic condition and up for everybody being in a worse off position. So, as economists put it, protectionism is not a first best policy, and not even be a second best policy, and eventually could be highly damaging. But of course, if we don't use protectionism or other restrictions, we have to figure out ways of either compensating or providing opportunities to those who are left behind, and that's going to be politically a meaningful challenge.
Well, do you think central banks will have to use these instruments again in the future?
Yes, I mean, now they're becoming part of the central bank's toolkit. They've been used once, they can be used again. Most of the time, there's a psychological barrier about using some of these instruments, especially going to QE, into negative policy rates, in credit easing, something that might be difficult to even conceptualize. And there might be, of course, political constraints or political economy constraints. But once those constraints have been passed or removed, that instrument becomes part of the central bank toolkit. Well, think about the Bank of Japan. They've been experimenting for the last 20 years about the instruments that they've used. They were the first one to use in modern age, so to speak, central banking, quantitative easing. They haven't been the first in introducing negative policy rates. This is something that the European central banks have done first, but that was among all new instruments that have been used, perhaps the most difficult to be accepted by banks who were affected by that and some policymakers. Think about the German case. But you know, now somehow the damage is done, and so central banks have won that battle, and they can use those instruments when and if is needed. The Federal Reserve, for example, they never went into negative territory with interest rates. Next time around, they might be forced to go there. They've said they might be considering that. They hope it's not the case, which is one of the reasons why they're increasing interest rates, to have a bit more room to cut. But you never know. Time will tell whether it becomes necessary for them as well to start going to negative rates.
Donello, do you think that in the current system there is a possibility, there is a risk that another crisis like the one we have seen in 2007 in the US and 2009 in Europe could emerge again?
Of course. Now the system has been made a bit more resilient by the actions of central banks or regulators or government. Some of the private sector behaviors have become also more prudent, but that doesn't mean that the new crisis can occur. A lot of instruments are now in frothy territory, somebody might even say bubbly, and therefore there's a risk of correction in the price of those instruments. If that were to emerge, a global financial crisis like the one that we have experienced starting from 2007, 2008, and eventually morphing into the Euro crisis in 2009 and so on, can definitely emerge. Just think about the amount of debt that has been issued to solve the previous crisis, which was already a crisis due to excessive leverage and excessive debt issuance. So to solve that problem, more debt was issued, and therefore if we were to encounter a new, say, systemic risk that materializes, all that debt will become potentially problematic, making a financial crisis possible and potentially even worse than last time. In fact, history has shown that each financial crisis has been followed by one that has been more severe than the previous one, simply because the cure that was adopted to solve the previous crisis potentially sowed the seeds of the new one. And so I wouldn't be surprised if we were to get there in the coming years.